Assalamualaikum warahmatullahi wabarakatuh. Hello, sir and friends. So we are from Group 1 that consists of me, Wildana Bia Prasasti, and also my friends, Aisyah Mahmud and Fahri Zaini Mulyana. So here we are going to present about the tax management in the selection of business firms in the tax seminar on tax management class. So the presentation consists of three sections. The first one from of businesses, from of partnership and company, and then laws and regulations for partnership company. So the first one, let's take a look from the for the form of businesses. The form of businesses consists of three points of generals. That the first one, sole proprietorships, business entities, and permanent establishment. So for the sole proprietorship for the form of business entity, the criteria is it is established by someone in their business activities. It is relatively simpler, easier in business licensing. So the tax rate for the sole proprietorship is progressive, which have the some advantages. The first one, the formation process is easy and inexpensive in establish the company, and then directly controlled by the owner, not to influence by the government regulations, and then the owner receives all profits and bears all business losses, and then the burden of income tax if the company is still below the PTKP. So for the weakness, it is limitations in obtaining the capital because there is only one owner. So for the business entity, the criteria here is it is established by more than 1% and witnessed by a notary or related institutions. It can be limited liability company or CP, firm, joint venture, cooperative, pension fund, partnership, association, foundation, state-owned enterprises or SOEs, regional-owned enterprises, mass organization, organization politics, and other forms of organization, whether for profit-oriented or not. For the permanent establishment, it is established by the individual who doesn't reside in Indonesia or resides in Indonesia for just less than 183 days in 12 months, and it is not established or not domiciled in Indonesia to carry out activities in Indonesia. So the tax rate for the permanent establishment is fixed rate. So the proportion is fixed whether the tax base is decreased or increased. And then the next one, the tax planning for choosing the sole proprietorship business entity or permanent establishment that can be mixed by taking into account various tax provisions. The first one, income tax rate, and then the next one, reduction of taxable income, bookkeeping obligations, income recognition, tax collection obligations, and tax debt liability. By choosing the right form of business, it can minimize the tax burden. So here are the illustrations for the form of business entities. Rich Corp is an sole proprietorship company. Therefore, calculating tax uses the progressive tax rate. The first one for income tax rate, here we can see by the calculation using the PPH Article 21. So the result is 26,800,000, 26.8 million. Using the corporate taxpayer, so just not using the sole proprietorship tax rate or individual taxpayer. So for the corporate taxpayer, the result is using the 22% tariff, which the result is 60,500,000. So the differences is 33,700,000. Rich Corp can save the tax among this because Rich Corp is an individual taxpayer in the form of sole proprietorship business. And then the next one is reduction of taxable income, which only given to individual taxpayer, not to corporate taxpayer. And then in the form of PTKP, non-taxable income, which the Rich Corp can save PTKP by 63 million. For the bookkeeping obligation, by the bookkeeping, so the tax payable can calculate by the taxpayer using the amount of their business activities, also include the norms of calculating net incomes. And based on law number 36 of 2014, individual who carry out business activities or independent work whose gross turnover 1 year less than 4.8 billion not only may calculate net income using the net income calculation norm, which Rich Corp here the sole proprietorship entities. So Rich Corp using the bookkeeping because its business turnover above 4.8 billion. For the income recognition, because Rich Corp is a sole proprietorship, there is no distribution of income that has been obtained. And by the owner, just by the owner of the company. And then for the tax collection obligation, Rich Corp is a paper industry in the form of sole proprietorship, so not subject to levy of income Article 22, but as PKP who has obligation to collect income tax Article 21 and value-added tax. And for the tax debt liability, Rich Corp is a company in form of sole proprietorship company, so the tax debt will be borne alone. So it is make the benefit for profit sole proprietorship because the company will pay more attention to their financial statements to avoid losses in the future. So the next one will be explained by Aisha. Thanks, is yours.
Okay, I will continue to explain about the business form as partnership company. The first one is limited liability company, or we call it PT. Limited liability company is the most popular business entity in Indonesia. When viewed from the aspect of the legality, PT is a legal entity because of the approval from the Ministry of Law and Human Rights and regulated in Law Number 40 of 2007. That is concerning a limited liability company. Based on Law Number 36 of 2008 concerning income tax, the imposition of PT tax is imposed on net income before the distribution of dividends to the shareholders. Advantages of PT. The company's lifespan can be guaranteed continuously and the shareholders have limited liability. There is a separation between the owner of the company and the management of the company. The company's capital is easily obtained from bonds and the sale of company shares. It is not too difficult to carry out the transfer of the owner. And then there are weaknesses of the PT. The first one is quite difficult to organize, and the organization's costs or funds are quite large. By establishing a limited liability company is quite difficult, and there are legal line of business restrictions, and there is a separation between ownership and control and others. Also, the characteristic of PT, the first one is the goal is to make a profit and has a commercial function as well as an economic function, and do not get facilities from the state. The company is led by the board of directors, and the highest power lies in the GMS or General Meeting of Shareholders. The company's employees are employees of private company, and the business relationship is regulated in civil law. Next one is fellowship. Fellowship like CV and firm, it is not a legal entities or tidak berbadan hukum, even though they were established by a notarial deed, because it doesn't require approval from the Ministry of Law and Human Rights, and there is no legal umbrella or legislation that regulates the problem of CV and firm partnerships. The taxation aspect of CV is regulated in Article 4, Paragraph 3, Reticle I of Law Number 36 of 2008 concerning income tax. In contrast to PT, the CV tax is only imposed once on net income. When the income is distributed to the owner in the form of private, it is no longer subject to the income tax. Therefore, the share of profits received or accrued by the members of the partnership is no longer an object of taxation. The next one is advantages of CV. The first is the funds needed to create this company tend to be larger. The liabilities borne by passive company are very few. It is very easy to find credit, and running a company will be more protected. Next is weaknesses of CV. First one is funds that have been given to a company will be difficult to retrieve because they have already been used to run the company. Liability borne by the active company is not limited. Assets held by an active limited liability company can be confiscated at any time when the company goes bankrupt. And then profits obtained then will be divided equally among its members. And then about law and regulations for partnership company. For limited liability company is an entity which is a capital partnership established based on agreement to carry out activity with authorized capital, which is entirely divided into shares and fulfills the requirements stipulated in the law number 40 2007 and its implementing regulations. Because PT is a legal entity, the owner's personal assets, both management and shareholders, are not directly involved in the company activity. Based on the existing regulations, the owner of the PT and the PT itself are two different things. For example, if the PT suffers a loss and has a debt, then the value of the loss and debt borne by the owner of the PT is not more than the amount of funds invested in the PT. In carrying out business activity, PT has the flexibility to raise as much capital as possible by selling shares or offering bonds so that the PT is easier to develop the business. This is due to its status as a legal entity and the technical ownership of PT is represented by shares. When the company develops into a public company, the scope of capital collection will be wider and more complex in many ways, including finance and taxation. The details of the type of PT or of PT business entity taxes or PT taxes that are mandatory for limited liability company taxes are as follows. A. Income tax Article 21. For those of you who own a business or manage a limited liability company, it is necessary to understand that Article 21 income tax will be the responsibility of the company as part of the limited liability company taxation as the party collecting or a withholder. Income tax Article 21 is a tax imposed on income in the form of the salary, wages, honorarium, allowance, and other payment for work, services, and other activity in whatever name and form is received by the taxpayer. This tax must be paid or deposited regularly every month. The company will deduct the employee income directly and deposit it into the state treasury. As the owner or management of the company, we are required to provide proof of the withholding income tax and then submit it into the state treasury. B. Income tax Article 23. As a company with the status of a limited liability company or PT, it is also inseparable from the obligations of Article 23 income tax. Income tax Article 23 is a tax that is imposed on income on capital, service delivery, or gifts and awards and other than what has been deducted by Article 21 income tax. This is the tax withheld by the tax collector from the taxpayer during transactions which include dividends or shared profit sharings, royalties, interest, gifts and awards, rent and other income related to the use of assets other than land or building transfer or services. The party receiving income will be subject to Income Tax Article 23. As a withholder of Income Tax Article 23, it is obligatory to make a proof of the withholding Income Tax Article 23 and submit it into the transaction partner. Furthermore, as a collectors of Income Tax Article 23, we have to pay or deposit the Income Tax Article 23 that has been collected into the state treasury. And then Income Tax Article 25. Not only limited liability corporate taxpayers, Article 25 income tax will actually be imposed on almost all taxpayers. Basically, Income Tax Article 25 is a tax installment originating from the amount of income tax payable according to the annual income tax return minus the withholding income tax, as well as the income tax paid or payable abroad that may be credited. Income Tax Article 25 is made with the aim of easing the burden on taxpayers. This tax must be paid within 1 year and the payment cannot be represented. Next is Income Tax Article 29. While Income Tax Article 29 is underpaid income tax that is listed in the annual income tax SPT, namely the remainder of income tax payable in the relevant fiscal year minus the income tax credit, which is Income Tax Article 21, 22, 23, and so on, and Income Tax Article 25. When the amount of tax payable by a company in a fiscal year is greater than the amount of tax credit that have been deducted by other parties and which have been paid by themselves, The excess value of the tax payable results in Article 29 income tax. E. Income tax Article 4 paragraph 2. As a taxpayer for a bit of a business entity, the tax liability that is usually attached to a limited liability company is Income tax Article 4 paragraph 2. And then Income tax final PP 23 2018. Final income tax is a tax imposed on the agency with a maximum gross turnover of 4.8 billion rupiah. Final income tax must be paid when income is received. This is due to the simplify the process and mechanism of taxation and reduce the burden of the tax administration, especially for taxpayers who are still developing and have not been able to maintain books. The final income tax rate for business with a turnover of less than 4.8 billion rupiah, in accordance with Government Regulation Number 23 of 2018, is 0.5%. It should be understood the use of the income tax final PP 23 2018 rate of 0.5% of gross turnover doesn't apply forever. Okay, the next material will be presented by Fahri. For Fahri, the time is yours.
Okay, thank you, Asia. I will continue this presentation. Limited Partnership or CV. In Government Regulation or PP number 23 of 2018 concerning income tax on income from business received or obtained by taxpayer or WP with certain gross circulation, each form of business entity has its own period of time to be able to use final income tax PP 23 to 2018, including CFE tax, corporate income tax rates, monthly CFE tax in the use of income tax final income tax PP 23 2018 of 0.5% of gross turnover signed 4 years ago must be willing to end it starting next year. Limited partnership or commanditaire vennoot cap or JV business entity is a business entity formed from a partnership between two or more people to achieve common goals in terms of entrepreneurship. Each member of the fellowship has a different level of involvement. The members of the partnership in question are active or passive partners. It's known CFE is not a legal entity, so the wealth or asset owned by CFE will be addressed to its founder. Just like other forms of business, CFE business utilities also have other tax obligations, especially income tax, because CFE is not a legal entity. If the founder of CFE receives income from a business he runs, it is not a salary, but is from the profit. Profits generated by CFE are only taxed on, namely when CFE makes a profit. This is what is considered actually established as CFE in Indonesia is more profitable than other business entities, such as limited liability company or PT. However, there is a provision where the profit is not object subject to income tax. The share of profit received or accrued by members of a limited liability company or CFE whose capital is not divided into shares, is not taxed, and is not included in the income tax object, alias excluded from an income tax object. This is accordance with what is started in Article 9, Paragraph 1, letter to determine the amount of CFE taxable income. The salary paid to members of a partnership or limited company whose capital is not divided into shares, partnership, association, firm, and joint venture, included unit holders of collective investment contract. The basis for the imposition of CFE business entity tax is regulated in the provisions of the applicable tax law, including being able to use income tax final income tax 23 UMKM in to 2018 within a certain period of time until finally the CFA business entity had to return to using the normal corporate income tax rate. Before a business entity in the form of a CFA is required to pay income tax according to the normal corporate income tax scheme, it can choose to use 0.5% UMKM final income tax according to PP 23 2018, but not within limit. CFA business entity only get 4 tax years to be able to use this 0.5% final income tax. The rest CFA business entity tax will be subject to normal corporate income tax as regulated in the provision of the applicable tax laws and the regulation. The freedom to choose this type of income tax is considered as an allowance from the government to CFA business entities, especially those who are just starting a business or starting their business, or just a CFA business that has been running from some time but is still its business development process. So that is considered more easing if you choose to switch to using the final income tax 23 2018 rate, even though you have previously used the normal corporate income tax rate. To make easier to understand the use of income tax UMKM final income tax 23 2018, see the explanation from the following instruction. A, namely establish CFA business form. CFA AAA was founded in 2021. In the year of established the business CFA immediately choose to use the UMKM final income tax rate according to PP 23 of 2018. Because the time limit for using 0.5% final income tax for CFAs is only valid for 4 years, therefore 4 years later, CFA must use the normal corporate income tax rate in 2025. The long-established CFA business from CFA BBB has been established since 5 years ago in 2015. In the first year, CFA BBB used the income tax final income PP 46 of 2013 rate, which was 1% of gross turnover. In the second year, CFA BBB was able to reap turnover of 10 billion a year. Thus, at the end of 2016, CFA BBB proposed to switch to using the corporation income tax rate. However, in 2019, CFA BBB's business performance declined. He only paid a turnover of 15 million. So it's the end of the 2019 CFA BBB submitted using the UMKM final income tax rate. Because the time limit for using final income tax 0.5% of gross turnover is only valid for 4 years, 2024 is the deadline for CFA BBB to be able to use income tax PP 23 of 2018. So, period of 4 years is calculated from the submission of the use of the income tax final income 23 of 2018 tariff. Based on Article 5, Paragraph 1, PP number 23 of 2018, certain period of time for imposition of income tax is final at the rate of 0.5% of gross turnover at the least, 7 years for private WP, 4 years for corporate taxpayer in form of corporative CFS or firm, to 3 years for corporate taxpayer in the form a limited liability company or PT. The period of use of the income tax final PP 23 of 2018 rate from the taxpayer is as of fiscal years of registered WP for WP registered since the enactment of the PP 2018 fiscal year, the PP come into effect for taxpayers who have been registered before the enactment of this PP. Referring to the provision in PP 23 in 2018 2018, the CFA that get a period to use of the final income tax rate of 0.5% of gross turnover is only 4 years, then this is the illustration of the explanation. CFA DDD was founded in 2017 with turnover of 25 million a year. Then CFA DDD proposed the use of the 0.5% final income tax rate, which come into effect for the 2018 fiscal year or beginning of the enactment of PP 23 of 2018. Because the period for using 0.5% final income tax rate for CFA business entity is only 4 years, CFA can only use this 23 income tax PP rate until 2021. Entering its 5th year, fiscal year 2022, CFDD must switch to using normal corporate income tax rate. In general, from the previous transaction carried out, the tax obligation of CFA business entities include: first, income tax Article 21. If the CFA pay employees income or salary, the CFA must deduct Article 21 income tax, then deposit or pay a result of the collection or withholding of income tax 21 on employees' salary to the state treasury. Second, income tax Article 22. No, then when the CFA makes transaction related to Article 22 income tax, it will be collected or deducted or must cut or collect income tax 22. Third, income tax Article 23. If the CFA transact with the government treasurer, the CFA business entity will also charge with income tax 22. Okay. Thank you. Back to Wilda.
Okay, thank you. So that's all about our presentation. If you have any question, please feel free to ask, and we say thank you very much for your kind attention. Assalamualaikum warahmatullahi wabarakatuh.